Well, thank you everyone for joining us today. Welcome back. My name is Austin Hagaman, and I am here with Adam Armstrong, and we are advisors with Withum Wealth Management. This is our third webinar here, the third webinar series of our market updates. You know what, Nick, you should make a note. We need some like horns or something. You know, I feel like all the cool podcasters these days have horns. Yeah, welcome back. For those of you returning, you know the drill. Today we're going to spend time walking through the market update deck that our firm puts together quarterly. This is just some of the information our investment committees look at as we decide how to shape and position our client portfolios of different types. And for today, Adam and I are going to specifically pick out a handful of slides that we felt are most relevant to take you through. Now, this is going to be more conversational in nature, very laid back. So, you know, instead of simply lecturing, Adam and I are going to hold a fluid conversation, moving from topic to topic. And it's going to be more casual, podcast-esque experience, less the sound effects, I suppose. With that said, please feel free to ask questions in the question box on your screen. We will be monitoring them and answering those questions throughout. And any questions that aren't answered today, we will reach out to you separately in a follow-up. Let's see here.
I'll also take a minute to plug the survey that will pop up after the webinar concludes. If you please can fill that out. I think we email a copy as well, but it's helped shape what we're doing today in terms of when during the day we host these, how long they are, how in depth we go on certain slides. So we really appreciate the feedback.
Yep. So quickly, because we do have some people on the line that are not clients, Withum Wealth is a white glove full service wealth management firm that eliminates common conflicts of interest in the investment industry to offer what we believe to be a much cleaner advisory relationship. We are what's called a true fiduciary, but there is more to us than simply needing to act in our clients' best interest. We have highly credentialed staff that help clients plan and invest for every stage of life. And we do have institutional level investment research giving us an expansive investment universe ranging from individual stocks and bonds to private investments. Adam, did I miss anything before we jump into the markets?
Let's dive right in.
All right, so where we go here. So I feel like listening for news updates on inflation has become a way of life for anybody in the industry. It's you wake up, you check the weather, you check the traffic, where's inflation, maybe think about some breakfast. It's like a top 3 priority in the morning. It's really what everyone's obsessing over. Kind of getting sick of it, not gonna lie. But can you give us an update on where we are?
Well, I can tell you don't have kids because you didn't name children in your top 3, but no, it's really been good news so far this year on the inflation front. On the chart here, you can see the big spike up in inflation. The blue line made it all the way up to 9% there and has come all the way back down to just above 3%, 3.1 if you want to round it. But core inflation, if you exclude energy, is still elevated near 5%. So
and that's the black line there, right?
Yeah, the black line there. The blue headline number does tend to foreshadow and lead oftentimes. So this is encouraging still. But as we'll talk about in a minute, the job is not over yet. It will get tougher from here for inflation to go, you know, I think we were talking about this the other day, that maybe from 9 to 3 is the easy part, and then from 3 to 2 is going to be just as hard as from 9 to 3. So the work is still cut out for the Fed here in wrangling this and making sure that we don't have a rebound like we did in the 80s.
Right, because this is really what the Fed is worried about, right?
Yep. You don't want to see inflation come down for a period of time and start revamping up.
Mm-hmm. Right. And I guess just since we mentioned core CPI, core inflation, the reason why core inflation is such a important metric for us to look at is because it takes out some of the more volatile components of inflation, such as food and energy. I mean, if you look at energy, you know, it was down 16.5, right? So that tends to create a lot of noise. So the reason for even looking at core CPI would be just because it takes out those two, more volatile components there. And again, sorry if I keep looking left, that's where my slides are. So as I write and draw you nice graphics, I will be looking at them.
Yeah, I think energy is the only thing that's actually quote unquote deflating. I don't want to use that word because energy and food are much more driven by supply than demand, right?
Mm-hmm.
If there's a drought in Mexico, avocado prices may skyrocket because of that. It has nothing to do with the demand for avocados.
Right. So let's just let's look at this in another way. So let me get my pen back down here. So what's amazing to me, so what we're looking at here is month to month inflation. Right here, that's the 12-month period. This is interesting to me. Where that last month, that June, it's already fallen off the 12-month, and we probably won't even include it on future slides. But look at that huge drop.
Yeah, and that's, from June to July is when the pace of rate hikes really started to be understood by the market last summer, right? And then we had the sell-off into the fall. But in July's data set, all we look at is a trailing 12-month number, and the last 12 months have been pretty tame, 3.1%. On the news yesterday, I heard someone talking about, well, the twos are right around the corner, inflation in the 2% range. Well, probably not next month, because if you look, July of last year was flat in terms of month over month pricing. So we actually expect inflation to tick higher next month. Don't be shocked to see a 3.3 or a 3.4 on inflation for July, because prices are still rising, albeit a lot slower than last year. But really a lot of that was energy driven, and a lot of the decreases we're seeing now, if you flip one more slide ahead, I think you can see the chart there where energy is down in the negative these last couple months. So everything is still inflating, just at lower numbers. The only thing that's actually taking away and decreasing is the green section there, energy, and you can see how much it was contributing last June, right? 3% alone in the month was due to energy. So this is something, this is why the Fed looks at core. They don't look at energy and food. And so while a 3% number is great, what's more concerning to us is still the fact that core inflation is in the 4s, 4.5. I think it was 4.8 last month.
Right, and this is important because the Fed's trying to target a 2% long-term inflation rate, right? Inflation went up, and what the Fed essentially needs to do is raise interest rates to create pressure on the economy, almost like they're putting their foot on the neck of the economy and slowing down how aggressively the economy can grow by increasing rates, which makes the cost of borrowing more expensive. Through a step metric, it makes it so banks aren't as willing to lend to certain parties, so that we can start to see that slowing of growth, right, which then would pull down inflation. And as long as inflation's high, they're going to want to keep that foot on the proverbial neck of the economy, right?
Absolutely. Yep. I mean, there are, I don't know, are you jumping to the leading economic indicators right now?
I was going to just mention them, because instead of just showing them, we did talk about them in previous episodes, right? So for the sake of time, in aggregate though, right, the leading economic indicators are flashing recessionary signals. The consumer doesn't seem to be having the same experience. So while the leading economic indicators in aggregate are saying, hey, there's likely going to be a recession, that the red light's flashing, the consumer's just spending as they were essentially. And then also when you look at another recessionary indicator that I like, which is whether each individual state in the US is growing or not, it's a great recessionary indicator. Usually if you have more than 50% of the US states saying that their individual economies are slowing, typically a recession is right at the door.
Yep.
You saw that come up a little. We saw that come up pretty drastic. I think we were at 25 states, maybe 26. Yeah, in the winter. But then it immediately dropped back down. So
that's been encouraging. Yeah.
Yeah. So I guess what I'm getting at here, though, is this slide specifically to the top right. Can you explain to the viewers here why there might be such a conflict, both between different economic indicators or leading indicators, and then also with the consumer?
Right. So the Fed has been raising rates. It's been sort of trying to slow bank lending, which it has been doing, which in turn has slowed a lot of manufacturing indicators and sectors. So these leading indicators that you're talking about that are flashing a recession signal, I think a lot of that is because of what the Fed is doing, because of the way the yield curve is shaped, et cetera. And so they're accomplishing that. They're slowing the economy. What they're not accomplishing, which is a big sticking point of inflation, is hampering the consumer. And we have shown this chart before, we focused on this before, but on the top right here, you have excess savings across US households. And the gray dashed line is a trend line, okay? That's been consistent over decades in terms of how much people save on average. And what you can see is right when the pandemic broke out, for multiple reasons. One, people couldn't spend or didn't know what was happening, so they didn't want to spend. And two, people were receiving immense amounts of stimulus. So you can see this personal savings line really spike up there. And then it spiked again in the winter of 21 when Omicron was bad, but also there was a second round of stimulus. So what did this do? This jump in savings rate caused there to be a mass excess liquidity or savings of, at one point it peaked out around $2.1 trillion. Okay, so that's the shaded blue area there. And what you can see is that's rolled over and is coming back down towards the trend. So excess savings are being drawn down. Part of this, spending boom that we've had, this pent-up demand, so to speak, of travel and vacations and buying things that people couldn't do during COVID, is running out. And we talked about in the winter this race against time. Will inflation come down first, or will consumers run out of money? You can still see today that the savings rate is lower than where it was in 2018, 2019, before the pandemic, which is a little bit concerning for us because these savings are coming to an end, right? So what happens when consumers run out of savings? They should go back to work if they're not working, right? The last 3 job reports that we've had have well outbeat expectations. So maybe we're seeing some of these people in the economy running out of money. They're coming back in the labor force, taking up a lot of jobs, right? That's why job growth has been great. They also may stop spending as much if they are already employed and running dry on their savings. And that would be certainly bad for the economy. I'll just conclude this slide and we can follow up on any points that I talked about, but the consumer is always a lagging indicator, right? People always feel good at the worst times. They feel bad at the worst times when they should be doing the opposite, right? Our human behavior, fight or flight mentality, really is meant to protect us. And we often should be doing the opposite. So if consumers are going to start spending more when they don't have the money, you could see, on the bottom right there, you could see credit outstanding become a larger part of disposable income, okay, which is typically what you see before recession. So definitely something to watch. This excess savings is probably going to run out at some point later this year. So that's where, when you add up the leading indicators and the fact that there's no recession today based on the state indicators, and that consumer spending should run out in the fall, maybe a recession's coming later this year or into next year.
Right. I mean, this is interesting stuff, right? This is reality TV drama here, right? This is Real Housewives stuff. We have the Fed with their foot on the neck of the economy, saying you need to slow down. Then we have consumers with this war chest of savings that they built up over COVID that has, helped keep the consumer above water as inflation moved prices up and things became more expensive. And it's starting to drain down, right? And which is going to occur first? Will excess savings run out, making the consumer have to cut back, which is going to create pressure on the economy, push us into that recession? Or will the Fed get inflation under control just in time? This is like an episode of 24. Will Jack Bauer save the day before the clock stops?
Right. I guess in true TV fashion, we should say stay tuned for next episode.
There you go. Yeah. And I think the important takeaway, just quick sum up, is this isn't a typical environment. We've never had an environment where we have a global pandemic, money flow into the economy, then this inflationary fight that the Fed is having all occur back to back to back, right? So it's creating this time is different event, right?
And maybe people just rein in their spending back to what was normal trend lines, and that could be a technical recession. We could see negative GDP year over year, but the markets might not care. And maybe that's what we've seen the last 3 months, just excellent market performance. The S&P 500 is up over 15% so far to start the year. Maybe that's what the market is telling us, is that when you boil it down, earnings expectations, they came down a lot last year, and maybe everything's going to be okay from an earnings recession. So the market is not necessarily the economy. I think that's the important thing we want to discuss here.
Right. And I think what's a product of this unusualness, this not typical environment that we've been put in, is historically, in order to see a drastic movement in inflation, you need the unemployment rate to go up first. So if you look at the chart we have up, the dark blue line, that is inflation, right? The teal is the unemployment line. As the unemployment line goes up, that means more people are becoming unemployed. If you look at any period especially where inflation is coming up, if you see that teal line coming up, what happens? What happens shortly after that increase starts to happen? Inflation drops dramatically, right? You can really just trace any line, and sometimes it happens sooner than others, but typically you need the unemployment rate to go up before inflation comes down. Right now, we're in an environment where where inflation has come down at a significant pace, and the unemployment rate has stayed pretty stagnant. Do you think, or would you say that this is linked to that cash hoard consumers built up during COVID? Like, do I even dare ask, do we even need to see a recession if inflation's coming under control without the unemployment rate increasing?
It's possible not. And you think about a lot of the transitory, which was, the Fed's favorite word 2 years ago, a lot of the transitory inflation is no longer around. So maybe a lot of this bump up that we experienced and subsequent fall down is just that. It's going to be the transitory stuff, right? We're not waiting for weeks on end, or shipping containers are not waiting weeks on end to distribute their stuff at the port of LA, right? We've shown that chart before. I waited a year and a half for like dining room chairs. It was ridiculous. We just got a dresser the other day for my daughter, and it was here 2 weeks later. So, those problems.
The paper's flowing again.
Yes, and so that was causing a lot of price increases because people wanted things and they wanted them now. So if you don't have to wait, then maybe you don't have to pay as much, right? The demand is still there, but because the supply chain is better, prices don't have to keep rising as fast. So it's possible we don't need a recession once all this money, is spent, I will say. Then sure, maybe we can live on our lives and we'll resume the normal business cycle, and we don't need unemployment to really permanently bring down inflation.
Right. And maybe a recession isn't actually all that bad. Yes, it does, increase the unemployment rate there, but sometimes it's good to, take the medicine and start with a clean slate and grow from there. One of my, unofficial recessionary indicators, and I think it's interesting that some of the major companies, the major analyst companies, are lowering their probability of a recession. their expectation of recession. They're lowering that probability, which, to me, it kind of questions, well, maybe we're getting closer to it, because typically when everyone's looking left, the economy goes right.
Yeah, I mean that I think that could affect the market too, right? If more people are pricing in no recession into the stock market, and then you do get a recession, then maybe that hits stocks a little bit more, right? Or maybe the market processes all known information and is generally right more than wrong. So, or I should say, the market's always correct because the market is the market, but people are often wrong. So yes, exactly. If people now are people were thinking recession, maybe it's less likely. Now people are saying definitely not a recession or less chance of one. Maybe there's a higher chance of one. Or maybe the market doesn't care, right?
Right. So I see in the question box, someone is asking if it started yet, can't hear anything. If you're on the line and you also can't hear anything, please let us know. But to answer your question, Jake, yes, we did start. Not for you to be able to hear me. Hopefully we can help you fix that though. All right, so AI has taken over the news. So I feel that this is an important slide for us here. So what are we looking at here, Adam? Are robots going to take over? Have any bets on which company will become our next Skynet?
Yeah, you can't turn on financial news without hearing about AI, so we needed to talk about this a little bit. This was a great research piece by Goldman Sachs that we wanted to highlight. They looked at different possible scenarios of artificial intelligence and the impact on productivity moving forward. And they said, well, what if AI is way more powerful than we expect, or what if it's way less powerful than we expect, or somewhere in between, a little bit more powerful, a little bit less powerful. Powerful in quotations could be seen as how widely is it adopted, what's the actual computational power, and how much is it helping us with our day-to-day work. The bottom line here is that I think the biggest fear for most people is my job going to get replaced? And then, what's that going to mean for me? And you can see here the dark, the green, the teal represents labor displacement. Okay, so this is actually what they're saying is productivity will increase if there's less workers working because of AI, believe it or not. The blue is increased productivity for everyone else who still has a job. So we just wanted to highlight this to show that, look, we're talking about real numbers here. Even a slightly less powerful version of AI, or what people think AI can contribute to society, is still going to add 1% of productivity growth over the next 10 years by Goldman Sachs estimate. That's fascinating. That actually translates to nearly $7 trillion of global GDP. Okay, $7 trillion just from AI. And we're talking about this because productivity means efficiency. It means better bottom line, better profits for companies, right? So if I'm let's say Microsoft, or Microsoft, right, owns ChatGPT, the probably most well-known version of AI today. If Microsoft all of a sudden can profit more or increase their profit margin, their earnings will increase, and that should boost their stock price. So it's possible what we've seen here, everything we're talking about, a recession and earnings will decline, that's possibly true in the next 12 months, let's call it. But it's also possible that, all these big companies are going to be earning so much more and profiting so much more over the next 10 years because of AI. And so I think that's why the market has done so well, and you've seen a lot of these big tech-focused companies performing very well so far this year.
Right. Yeah. Market Insider had a piece where they stated that a study from Stanford and MIT found that workers at a Fortune 500 software company who were given generative AI tools got 14% more productive. Those gains approached 30% more productivity for the least experienced workers. I mean, that's huge. Like for those business owners out there, imagine if everybody at your company was 14 to 30% more productive, or even the non-business owners. Imagine if you got 3 to 4 hours more in every day, right? That's 14. That's right in that range. Like think about how much more you could get done, and then what that could mean for profits, right? In terms of hourly work, the net profit margins could have a substantial increase. There was the steam engine, the internet, commercial air flight, right? Big revolutionary technological changes that really changed the way we did business. And yeah, they didn't always. Sometimes they got to a sprinting start and then they slowed down before they could build back up again. But this could be equivalent, right? So what do you think, Adam? AI stocks to the moon? Should we just hammer down on AI stocks?
Yeah, I mean, whenever you start talking about things 10 years in the future, that's probably a bad sign, to be honest. But I think there's some legitimate. I mean, look, we wrote an article about a month ago. I shouldn't say we wrote it because ChatGPT wrote it for us. If you haven't read that, reach out. It's on our blog. But at the same time, these are real dollars that these companies are going to profit, whether you're losing your job or not because of AI. This is a callous business that we're in, and the stock market doesn't care about that, right? They care about profits. So we do have a responsibility to make sure that we're investing in companies that can benefit. Let's go to the next slide. Yeah.
I'll just add real quick. What I think the beauty of AI is that we don't need to just invest in AI stocks and over-concentrate in them to get the benefit from it. You're going to have companies like Walmart or healthcare companies, quality companies that are already producing solid cash flows that you don't need to necessarily take a big AI bet on, that can use AI very productively, right? Who can benefit, their returns can benefit from AI. So, going out and looking at those companies that are quality companies, those that have management that are going to take AI seriously, that could be huge. It's not just all about the AI stocks. Like you don't need to take that bet. You could see good returns elsewhere from AI, should this take off the way that people are thinking it may.
Well, eventually the proof has to be in the pudding, right? So if there's promise in these tech companies, or, not to shout out NVIDIA, right, but they make a lot of the chips that drive a lot of this type of computational power, eventually they have to report their earnings. And if the expectations are sky high or to the moon, as you said, and even if their reality is fantastic, but it doesn't meet those expectations, the stock could fall. And right. Not that it has to do with AI, but Netflix earlier this week reported earnings, and it was a great report. I think they beat their guidance, but it was still below the street's expectations, and the stock fell 10%. I mean, look, it had run up so far so fast, but it's just a match of reality versus expectations. And I think a lot of the news has gotten caught up in the big tech trade here. And that's why a lot of these big tech companies are doing so well this year. But to your point, there's no reason why Walmart can't actually be the one that beats expectations the most, because they're using AI most effectively to enhance their bottom line, right? So AI can have wide-ranging, very wide-ranging effects on different types of companies. I think it's just the big tech companies that have benefited thus far. And a lot of that is not earnings based. It's a lot of optimism. It's just honestly probably some hype and some coming truth over the coming years that the tech companies will benefit a lot from this, but everyone should benefit a lot from this.
The old Wayne Gretzky quote, don't go where the puck is currently, go to where the puck is going, right? Even if you missed out on the tech jump, right? You don't miss out on the impact AI may have on other companies. So let's hop through. So I'm sure everyone's heard on the news that the top 10 largest names in the S&P 500 now represent 30% of the index. And some of these names are pretty big. I mean, Apple's market cap right now, Apple's market cap's right around 3 trillion. The Russell 2000, all 2000 companies in the Russell 2000 small cap index, they represent just under 3 trillion. The FTSE 100, which is a large cap international index, that's only 2 trillion. So just one stock is commanding so much of the market right now. And the media has been flooded a bit with pundits expressing concern for low market breadth. And we did some research on this. Can you explain to our listeners what we found?
Yeah, so market breadth is how narrow or wide the returns are, right? Is every stock in the index up 1% and that's great? Or, is it 4 big stocks are up a ton and then every other stock is flat? And so on the left side of this chart, you can see that of the, call it 17% at the time of this chart earlier this month, that the S&P has returned, these 7 stocks have driven 2/3 of that return, okay? And these happen to be the big tech companies. A lot of these are riding the wave of AI and productivity growth there. So this has been a narrow market thus far, but that's not necessarily a bad thing. And one of the main, I hear it a lot on TV, don't put your money in the market because these things are going to come back down to earth, or don't buy those now, don't chase it, they're going to come back down to earth. It's oftentimes not the case, actually, when you see narrow markets like this in the past. The S&P as a whole tends to do pretty well afterwards. And so instead of having those high risers come back down and meet the rest of the market, you end up having the rest of the market come up and meet those early advancers. So talking about AI and using our examples here, if AI really, the optimism drove a lot of these initial gains, it's going to then wear off and people will realize that, yes, biotech companies and Walmart and other, more normal economy companies can also use AI, even though they're not direct beneficiaries. They can be potentially bigger indirect beneficiaries down the road. So this chart on the right here, when you have a period of time where the biggest 5 companies outperform, like we're having or just had, you tend to see very good forward 12-month returns. Okay, so this is, yes, there's optimism in a few names, but this could be a tailwind for the overall economy as we're talking about.
Right. Yeah, and I think the important part is market breadth is important, right? If we go for a very prolonged period of not seeing that the rest of the market catch up, right? That is something that certainly flashes a light, but it's not something we necessarily need to be scared about at this moment, as certain people may be proclaiming. So Adam, looking at these names, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla, do you think they deserve such a big spot in our index? Do they deserve to be top 10?
It's such an interesting debate, and I've been trying to look through history and figure out, was there ever a time in the last 100 years where any company was just so impactful to our daily lives as, say, Apple is today, right? Maybe Apple deserves to be worth the size of all of the small companies out there that are publicly traded in the Russell 2000, because I don't know, was there 40 years ago, 50 years ago, 70 years ago, was there something you just couldn't leave your house without, right? Like people freak out if they leave their iPhones laying around somewhere. It's your persona, right? Your credit cards are in there, your wallet's in there, all your notes, all your messages and pictures, and right. So some of these big companies, we use Microsoft Office Suite for our email, and we communicate via and do virtual meetings via Teams chat, which is a Microsoft product. And, we use hundreds of spreadsheets daily in our business on Microsoft Excel, and we write our rough drafts for our quarterly letters on Microsoft Word. So a lot of these applications and companies are just so ingrained in our daily lives. Maybe it does warrant these valuations, right? Maybe
Yeah.
the moats that they've built over the decades are worth paying up a little bit more valuation for. Maybe that sets them apart.
And not only, you know, are they such a big part of our day, they have great profit margins. I mean, I don't know if we've ever seen such great profit margins from, you know, companies like these, where you have the mega cap 8, right? The top 8 companies have an average profit margin of 20%. If we take out Amazon from that, the average profit margin is 27%. The rest of the S&P 500, x those mega 8 cap, then the eight largest ones, their profit margin is 12%, right? So, you know, they're certainly, you know, they have a healthy business going on. Now, what I did for fun was I went back and looked at the top 10 stocks back in 2003, and then I compared returns of those stocks versus the overall market. And what I found was from 2003 to the end of last quarter, the total return of the S&P 500 was 480%. The average total return of the top 10 stocks from 2003, 175%. So not even half the return of the S&P 500. And of those 10, seven of those top 10 stocks returned less than half of the S&P over the period. Some even returned negative. So this is a reoccurring phenomenon, right? This happened before 2003 as well. And every single time, I'm sure if you were to look at the top 10 companies in the S&P 500, you'd be saying the same things. Well, these things play such a big role in my life. You know, of course they're going to be around forever. Of course they're a great company. Well, 20 years is a lot of time. Even 10 years is a lot of time. And there's a lot that changes. And what you find is companies get so big that there's internal politics. They don't want one service or change in one solution to cannibalize another. You get the government who steps in. All these things that keep them from being a little less nimble than the smaller guy, and you typically see that smaller company come up and take advantage of that. So, you know, I definitely wouldn't be surprised if in the next 10 years, you know, we don't see any of these names. And by the way, in 2003, none of the 2003 top 10 names are currently a top 10 name.
Yeah, I mean, you can even look at some of the names right here that you highlighted. Tesla was not even one of the top 20 names 4 years ago, right? They had an amazing run up in the pandemic, and valuation aside, they're making, you know, 30 times more cars than they were at that point in time. So, you know, I don't know if they deserve to be there or not, but they weren't there 4 years ago even. And I think they're in, you know, if not the top 10, probably pretty darn close to it. NVIDIA, the chip maker, same thing. I mean, 5 years ago, they were not in the top 10. So a lot of these companies that are in the top 10 today, you think of them as household names that have done well, but they weren't there 5 years ago, right? They weren't where they are. And maybe NVIDIA is the largest company in the world, you know, in 5 years from now, because of the importance that chips will play, semiconductors will play in our lives. So, and maybe maybe we won't need iPhones in 5 years from now, because we'll have communication devices implanted into our brain or something. We're getting a little ahead of ourselves here, but that's the point, is you still need to diversify. You can't chase returns. You have to participate smartly and be wary of valuations.
Yeah, and recognize valuations, which brings us to our next slide. We had a big market run up, right, year to date. How are we looking on valuations?
Yeah, so a lot of this run up actually has been just, when you look at valuations, you're considering the price to the earnings, and you get a ratio there, right? The P to E, or the multiple is what it's commonly called. You know, historical average over the last 25 years is between 16 and 17. We are a little bit higher valued at 19 times forward earnings, but we're not excessive. Okay, so one standard deviation away would be north of 20 forward earnings. So it's not, I would say the market is richly valued, but it's not overvalued or extreme based on historical averages. Furthermore, if you take out some of the big, mega cap tech names like Apple, Microsoft, Google, et cetera, the overall rest of the market is priced right around historical averages. So a lot of this is just price movement. Earnings will catch up in the future, right? If you recall, the stock market is always forward looking, it's anticipatory. So prices, of course, will rise in anticipation of those earnings rising, okay? And you can see coming out of every bear market and or recession that we've had, the earnings multiple does increase. So if you go back to 2002, you can see from 2002 through 2003, it rose there from about 15 up to 18. In coming out of 2008, you can see it rose from 10 times earnings up towards 14, 15, 16. We almost had a double dip recession in 2010 and 11, and you can see in 2012 and 13, prices started to rise before eventually earnings did. Same thing coming out of COVID, and that's what we're seeing now. So it's possible we're just seeing a normal reacceleration of earnings that will take place over the next year, and prices are moving higher to reflect that.
Right. And I think it's just worth noting that PE ratios don't necessarily have predictive powers in the short term. High PEs only explain about 5% of the following year's returns, the following 12 months returns. And the predictive powers do grow as you expand the time horizon. But even over a 5-year period, PEs only explain about 30% of future returns. So we did have some questions come in. There's two that are kind of related, so I'm going to handle them together. Should additional monies be directed to the bond market for both the short and long term? Then also, there seems to be several small banks offering 7% interest on savings accounts. Should we be taking advantage of these offers? Now, I'll say that
7%.
It says 7%. It's high.
7%.
I'm wondering if that's an entry rate and that pops down after a couple months. But
well, let us know where you're finding 7%.
Yeah, exactly. But so BlackRock put out a piece just recently that I think makes a lot of sense, because when I view this question right there's I'm looking at it two ways. Are we saying put it in cash over put it in stocks, or are we saying take it from a checking account, putting in cash? So let me just tackle cash versus stocks. And BlackRock has a piece they just put out, Be the Buffalo, Weather the Storm. It says, when headlines about the market turn negative, many feel the need to act, but acting impulsively and following the herd in the short term can negatively impact your chances of achieving your long-term goals. The cow runs away from the storm. If you're moving money into lower risk cash equivalents, you are following the herd like a cow. History shows you may underperform in the long term. Buffaloes charge into the storm to shorten its pain and frustration. By staying invested through downturns or buying when others are selling, you are running against the herd. History shows you may outperform. And they did an analysis from 1993 to December of 2022 and said if you had cash on the sidelines and you only put it to work when everybody else was buying, so presumably when the market's on its way up, your return would have been 5.5%. If you have cash on the sideline and you're putting money to work when the market's going down, when everyone's selling, your total return over the period, or your return over your annualized return over the period was 13.9%. So, it makes sense to be a bit of a contrarian. You don't want to follow the herd when it sounds like people are uncomfortable with the market, or even when you're uncomfortable with the market. It never hurts to put money in, especially if you're dollar cost averaging.
Yeah, and related to whether they should be investing more bonds or not, I mean, that completely depends on your time horizon. It completely depends on your individual plan and what the money is coming from, to your point, right? Are you putting more money towards stocks periodically, and you're considering bonds instead because rates are at 5.5%, 6% on corporates? It might not be appropriate given your goals. You might still want more growth over the long term from stocks. And likewise, if it's a cash alternative, then yeah, probably makes sense to be putting it into treasuries or something pretty safe. So I think we're bumping up on time, Austin. So why don't we can cut it here and conclude, and thank everyone for joining as always.
Yes.
And we'll make
There
one
will be
last plug to
one last plug for the
fill
survey.
out the surveys that are coming your way.
Okay. Yeah. When you exit the webinar, there will be a survey that pops up. Please fill it out. As much as you have time for. We really do appreciate it, and thank you for joining us.
Thank you.